Welcome back everyone to part number 3. Let's discuss international credit market. In the previous video, we discussed money market. We said that money market is meant for those borrowers and lenders who want to trade or lend and borrow in less than 1 year. How about more than 1 year? Some people or some companies, some governments need to borrow money for a longer period of time, for 2 years. Some project, building some highway, you need to repay after 5 years, etc. So MNCs sometimes obtain medium-term funds. We called it medium term, between 1 year and 5 years, through term loans from local financial institutions or through issuance of notes, medium-term debt obligations in their local markets. So we have two options. Say I'm McDonald's again, I need 1 million ringgit for 3 years. Okay, so I want to pay you back after 3 years. I have two options. Number one, borrow from banks in Malaysia. Number two, issue bonds. So I can issue bonds, people will buy my bonds and I will pay them interest. So loans of 1 year or longer extended by banks to MNCs or government agencies in Europe are commonly called Euro credits or Euro credit loans. So basically, loans of 1 year and more extended by banks to MNCs or government agencies in Europe are called Euro credit loans. How about syndicated loans? So we discussed that companies such as McDonald's might need huge amounts of money, 10 million ringgit. Why? Simply because they buy huge, assets such as some asset located in Bukit Bintang. McDonald's nowadays, they make more money from buying these assets and renting it out to people compared with selling food. So these companies will basically need a high amount of money, say 10 billion. Maybe one bank on its own does not have sufficient money to lend to McDonald's, or maybe the bank finds it too risky to lend 10 million or 10, like a huge amount of money to one borrower. So sometimes we will find that we will need 10 million. However, this 10 million will be provided from 3 or 4 banks. So you will notice that one bank will take the role of the lead, so they will be dealing with the company. However, the money is provided from not one but more than one bank. So sometimes a single bank is unwilling or unable. So sometimes unwilling doesn't really want to take that huge risk. Sometimes unable, I don't have that much of a money. Imagine Google, Apple, like these people, they borrow huge amounts of money to lend the amount needed by the MNC or government sometimes. A syndicate of banks can be formed to underwrite the loan. So we will form a syndicate of banks. And the lead bank is responsible for negotiating. Who's going to discuss the terms with the MNC? The lead bank, usually with the major share. Okay. Let's continue with the impact on the credit market. You all remember the subprime crisis in 2008. So basically, there was a bubble. This bubble burst, leaving people with the domino effect. So a big bubble burst, leaving dominoes falling one after the other. So the crisis of 2008 triggered by defaults in subprime loans led to a halt in housing development. So where did it start? In housing development. Houses prices were appreciating so high, people buying more houses, then suddenly people didn't have tenants, so they didn't have money to pay back the banks. One bank started falling, the other banks started to follow. Okay, leaving a halt in housing development, which reduced income, spending, and jobs as well. Financial institutions became cautious. So, why am I telling you this? Does this scenario or crisis affect banks? Of course, now banks are more cautious to lend us because now they are more cautious with their funds and we're less willing to lend funds to MNCs after this kind of big crisis. Now let's move to bonds market, okay? So there is a platform again, a market to buy and sell bonds. So we discussed McDonald's issuing bonds. They needed to borrow, they issued bonds, people bought their bonds. Now, after you purchased the bond, you needed money. Can you go back to McDonald's and get your money? No, you have to wait. However, you can sell the bond to someone else. Let's say me, for example, I want to buy a bond now. Okay, so this basically buyer will sell his or her bond to me and I will wait for McDonald's to pay me. Okay, so we call it a bearer instrument. Whoever have the certificate gets the money at the end of the period. Now, what is foreign bonds? Foreign bonds are issued by borrower foreign to the country where the bond is placed, okay? So, I am McDonald's, I'm from US, but I am issuing bonds in Malaysia. I want to borrow from Malaysians. So Euro bonds, as we were discussing just now, an international bond issued in Europe or elsewhere outside the country in whose currency its value is stated. What's the features of Euro bonds? As we said, bearer bonds. So whoever carry the bond at the maturity date will get the proceeds, get the money. Annual coupon payments. So basically, every year you are basically eligible to receive an interest payment. We called it coupon payment. And it's convertible or callable. So McDonald's at any moment can call it back and pay you back your money. So the development of other bond markets. Do we have other bond markets other than Europe? Of course, we have bond markets in Asia, South America as well. And similar to other discussions we had, when economic conditions weaken, when the economic conditions are terrible, such as what we live in right now, Corona, aggregate demand for funds decline. Not many people want to borrow money with the decline in corporate expansion. So companies don't have new projects, don't have new products. They are just trying to protect what they have and not go out of the market. However, on the other hand, when economic conditions strengthen, aggregate demand for funds increases. You want to offer new products, you want to penetrate new markets, you want to do more things to attract more clients and get more profits. So you need maybe to borrow more. Okay, so what is the risk of international bonds? First, of course, we have interest rate risk. Potential for the value of bonds to decline in response to rising long-term interest rate. So if I have a bond, the interest rate is 5% for 5 years. So for 5 years, I will be getting 5%. However, after 2 years, what happened is interest rate in the market increased to 10%. So now lenders earn 10% instead of 5 only, double what I earn. So demand for my bond, if I want to sell my bond now, the value will be less than the market price. Why? Because no one is interested. If people want to buy a bond, they can get 10% nowadays. No one is willing to buy yours at 5% and vice versa. Sometimes yours is 10, market price is 5, so everyone wants your bond now. Why? Because it pays higher interest for the remaining 3 years. Of course, now demand will be high. Everyone wants my bond, so I will basically sell at a higher price. Exchange rate risk, it always exists when you trade in other currencies. Represents the potential for the value of bonds to decline. Decline from what perspective? From my perspective, the owner perspective, the investor, right? Because the currency denominating the bond depreciates, okay, against the home currency. So I am from Malaysia. If my bond is in euro and the euro is depreciating against my currency, at the end of the period, when I convert my money back to ringgit, it will be less, simply because of the changes in exchange rate risk between the beginning of my contract and the end of the contract. Liquidity risk, we also discussed this before, represents the potential for the value of the bonds to decline. So what's liquidity in dollars? How much volume USD trade, right? What is the volume for this bond? Of course, how many people buy and sell. Which one is better if you have bond A, bond B? Bond A is bought and sold 100,000 times, bond B 1,000 only. Of course, bond A. Why? Because 100,000 people bought it and sold it. So I expect if I buy it, I can sell it easily in comparison with bond B. Bond B, only 1,000 people deal with it. Same with the example of currencies when we discussed USD and Cameroon currency. Finally, we have credit risk, of course, represents the potential for default. So in my example, I discussed McDonald's. We said that McDonald's will not default. It's a big company. However, other companies will also issue bonds. However, these companies might not be as big as McDonald's or as popular as McDonald's, so they might default. So when you buy bonds, you have the risk that this company, even though it's a big company, it might default and you will lose your money. Okay, now let's move to stock market. Again, a market is a platform. Now to buy and sell stocks. What is a stock? It's an ownership in a company. If you have the stock of Google, you are an ownership of Google company, maybe a very small fraction. If you buy 1 million stock or 1 million, 1,000, you become bigger owner and bigger owner. So it's just a partnership in some company. You are basically a partner or an owner, or what we call it, a share or stockholder. So some US firms issue stocks in foreign markets. So a US company might issue stocks here in Malaysia to attract Malaysians, to get more popular in Malaysia, to enhance their global image. So image for the euro, impact of the euro resulted in more stock offerings in Europe by US and European based MNCs. So after we had the currency of the euro for the whole nation, for the whole European countries, more people were encouraged to go to Europe and issue their stocks in euro, basically, to buy. So what about foreign countries issuing in US? So let's say Petronas want to issue stocks in US. We call this Yankee stock offering. So non-US corporations that need large amounts of funds sometimes issue stocks in the United States. We have something else called ADR, American Depository Receipts. It's a certificate that represents a bundle of stock. So you pay, say, 10,000 ringgit, you buy one stock in company A, one stock in company B, one stock in company C. Together, it's like a bundle. So certificates representing bundles of stock, ADR, shares can be traded just like shares of a stock. Finally, non-US firms listing on US exchanges. So non-US firms have their shares listed on the New York Stock Exchange or the Nasdaq market so that the shares can be easily traded in the secondary market. So sometimes, again, we have non-American companies, but you notice their share can be bought and sold on the Nasdaq or the New York Stock Exchange. Now, let's discuss the effect of Sarbanes-Oxley Act. We discussed this act that it relates to governance. Now, governance is more complicated. It's more difficult for companies to do business, let's say, in the US due to this new governance system. Why? Because you have to follow standards. You cannot do things your own way anymore. You must follow a very strict standard manual, let's say. So many non-US firms decided to place new issues of their stock in the United Kingdom, in UK, instead of US, so that they do not have to comply with the law. And this is what I discussed with you before. Sometimes companies, MNCs, are afraid to go to a country where laws are complicated or very strict. So, for example, high taxes on foreign companies, or as we've seen here, high level of governance. So you want to do business here, you have to keep, so many requirements. You have to keep minimum capital, you have to open 2 accounts in USD and Malaysian ringgit. So if we make requirements are strict and high, many companies will find other countries. And that's why that's how capital, we say, flies from one place to another, seeking better environment for the company and the shareholders. So with this, we end the lecture here. Thank you very much for listening, and please don't forget to write down your questions or take notes, and please don't forget to write down the slide number so we can easily refer to it during our Q&A session. Wassalamu alaikum wa rahmatullahi wa barakatuh.